Palisade Radio is preparing to release an in-depth report on the fundamentals of uranium, including our top 3 picks for 2019. Sign up today at palisaderadio.com to be the first to receive our exclusive report.
Welcome back to another episode of Palisade Radio. This is your host, Colin Cattell, and we're finishing up our 10-part uranium series today with a new guest on the program. His name is Joshua Hall. He's an investment advisor and owner of True Vine Investments. You might also know Joshua if you're on Seeking Alpha. He's a major contributor under Industrial Mine Finder, where he has over 100 articles that he's written, a lot of great information. So if you enjoy this discussion, I would definitely suggest going on to Seeking Alpha and looking at some of Josh's posts. Josh, thanks for joining us today.
Thank you for having me, Colin. I've been looking forward to it.
Well, let's start with uranium. That's not the only thing we're going to talk about, but we've done 9 parts of 10-part series on uranium. We've had everybody you can think of come on, investment advisors, experts, big investors, and the general case has been that everybody's quite bullish. And of course, it's a bit of a biased discussion because we are getting resource investors into the space. But the bull case for uranium does seem to be coming together at this point in time. So, what is your overall thesis or consensus on the uranium space?
Yeah, I would say that I'm definitely in agreement with the consensus. View is that the uranium market really began this year with the price movement that we've had this year. Really kind of jettisoned by the mine cutbacks, and just actually last night I noticed that there's an IPO I think tomorrow for uranium. It's called uranium trading. So we've seen a couple IPOs come out to invest in uranium, and it really seems like there's a lot of money preparing for the sector because they see the same thing.
For sure, and the incentive price for production, of course, everybody is well aware, is below where it needs to be, probably substantially below, at least to get new production online. Have you given any thought to where you see the prices rising over the next couple of years?
Yeah, I see really no issue with the price returning to that $40 to $50 range at least, because you have big producers like Cameco, basically telling the market that they're keeping production offline until they can get that level of pricing. So the question is, there's some big potential mines coming online, but they're still probably, 5 years away. So the question is, if we get that price rise over the next year or two up to the $40 to $50 range, does it keep moving, or does it, does it keep moving until we get those bigger levels of production coming online, or does it stay there? So that's kind of something I've been working on right now with some additional analysis to, I would say, come up with a firm conclusion there.
Historically speaking, uranium does overextend in terms of the incentive price. It can rise substantially above the needed incentive price, and that's exciting as an equity investor in the space, especially when you look right now. There's not all that many uranium companies available for people to purchase. There's a couple of the premium ones. There's Cameco as a producer, and then there's, of course, Denison, NextGen, and a few explorers left below that. What is your way that you're looking to play the space?
I'm as far as miners, I'm focused on the Athabasca Basin in Canada, just because of the wealth of high-grade, large deposits and the ability for the companies operating there to produce at a low cost. One of my, there's different types of mining investors. My focus tends to be on low-cost producers, high free cash flow margins to return cash to shareholders. That's really my main focus. So that has me interested in some companies there, and it also has me just interested in the metal in general, just owning the metal a bit more. I guess you could say I'm taking a more conservative track than probably some other investors.
Excellent. Well, let's continue and talk about the other metals. The commodities sector is certainly quite interesting right now. It's at a bit of an inflection point. Many of the industrial metals have dropped off significantly. Oil is, of course, completely different animal, but it's had a precipitous decline the last few days. Gold's been holding in pretty steady, and then kind of the equities as a whole have been getting hit pretty hard. Where are you most interested or focused when it comes to the commodity spectrum?
Yeah, I launched my Industrial Mine Finder newsletter about a year ago, and it's been a little bit of a rough first year, but we're hanging in there. I guess you could say my macroeconomic view really is that China bottomed in the 2014-2015 timeframe. I mean, when we're talking about mining and in particular base metals, you have to have a view on China. You see articles come out that they talk about Dr. Copper and the U.S. economy, and the U.S. economy consumes only like 10% of the world's copper supply. So there's a lot of things that you see out there, you read about that really are not too relevant when it comes to base metals, but definitely China is the most important factor. So my view right now is that China still has in this current upward move that's been hitting the metals really since January 2016. China still has about 3.5-4 years left probably to go. And I think what we're seeing now is kind of a major, well, I guess you could say double bottom, where December 2015 was a major bottom. We had a really strong rise in 2016, 2017, especially for industrial metals. And this year has been pretty much across the board, except for a few exceptions, it's been a major pullback, which I think is going to be a double bottom, a little bit higher than the last bottom, but it's going to be a double bottom before a major move coming. And there's a couple factors a couple reasons why I say that. I'm in particular, I like uranium, like we've talked about. In particular, though, I'm most bullish on the base metals, zinc, copper, and nickel, primarily. And the reason being is because all three of these metals are now in deficits, and we can talk about them one at a time. I think the most interesting one, and probably the one that the market has wrong, is zinc. And one of the big factors behind zinc is, right now, I would say I'm estimating that next year, zinc supply, if everything works out and there's no major mines going offline, is going to be about 14.6 million tons. And an important aspect of that is Chinese production. And China accounts for, not only does China consume a significant amount of zinc, but they account for 37% of the mine production. And one of the things that's happening that I've noticed that's been happening in China that really is really flown under the radar is that the Chinese mine production is not being able to keep up. It was supposed to increase this year by like 5%, approximately was what the kind of consensus was. And it's actually, I think it's actually down on the year. So when you talk about China accounting for 37% of production, and it's supposed to increase 5%, and it doesn't, 5% of that is like 260,000 tons a year. So there's been a lot in the financial media about all these big new zinc mines coming on, and there are some big new zinc mines coming online. But what I'm saying is I still don't think it's going to be enough to balance the market, and so I expect zinc to come roaring back and really surprise people. And you can go out, you can look at. I frequently go to Kitco Metals, and I look at the inventory levels. At least they have the London Metal Exchange levels there, not the Chinese exchange levels. But you can see for zinc, for copper, for nickel, all three of those metals are at or right near 5-year lows in inventories. So if you're reading the mainstream financial media, everybody's calling for a slowdown, and my view is that really right now is the point where is a good time to be buying, and the market is really beaten down mining companies across the board, especially the base metal miners. So I think we're going to see a big surprise. Over the next 6 to 12 months, we're going to see a big surprise out of the base metals.
Now, Josh, how do you factor in the potential weakness that has begun in the U.S. equities market? And a lot of people perceive, at least, that the price of something like the Dow Jones or the S&P is indicative of the strength of the U.S. economy, and also, as an extension of that, the Chinese economy, as most of these markets tend to trade together. What do you see as the risk to both base metal commodities and the associated stocks if we see an overall sell-off?
Going back to China, China definitely has had something of a slowdown this year, which has been hitting the Chinese equity market. The fears over the trade wars have been hitting both markets. So there's definitely been a slowdown, but I would say going back to those, the metal demand, that's really what gives me the most confidence, that it's not anything really to be concerned about, but that the underlying fundamentals with China are pretty strong. I'm still bullish on the U.S. stock market in general. I think it has a little bit more room to run. But if I'm wrong and the U.S. economy's kind of getting ready to roll over and the U.S. stock market is going to roll over more, I think a lot of that has been priced in already to, various mining companies. So there's always more damage that could be done, but, I think the values are such that if you're careful and you're patient and you're selective, you can buy into, you can still do well even if the U.S. economy weakens, just because, again, the industrial metal demand is so much connected more to China than the U.S.
Josh, another metal that you've written about recently also ties into the uranium story, as a lot of uranium sandstone hosted deposits also host vanadium, and very much so tied into China with their new steel rebar requirements. Vanadium prices have been on quite a tear. You wrote a piece talking about Largo, which is, of course, a Brazil producer that's been in a bit of a vertical chart pattern following the upswing in the commodity. What is your feeling on vanadium moving forward?
I would say I have become more bullish on vanadium. Now, when I say bullish, I think that the price can stay where it's at now, maybe go higher, but it stay, on average, on an annual average, stay where it's at now for another year, maybe two. When I initially looked at vanadium, I looked at some of the cost curves and so on, and there's, the cost curve will show you that, right now the vanadium demand is roughly 90,000 tons, but if you look at various cost curves, you'll see that there's 100,000 tons of potential supply. But the question is, in the past, we've seen kind of marginal supply come from China, from stone coal producers, and even places like Venezuela, where they get byproduct vanadium from, oil processing. So it's questionable whether those kinds of supplies are going to come back online. When I first looked at vanadium, I was concerned about that, and I was not quite as bullish. But the more I looked at it, another factor coming into play is that most of the world's vanadium is produced as a byproduct of steel processing. So there's only 3 primary vanadium mines in the world right now producing. There's Largo's, Maracas mentioned, there's Bushveld's, Vametco, and there's Glencore has a mine. I think it's called Reheno Rahonovan or something like that in South Africa. But the rest of the world's vanadium supply is a byproduct of iron ore production. So you have companies like Evraz, the Russian steel company. They produce about 20% of the world's supply, but they can't really add vanadium. They can add a little bit here and there, but they can't really bring on meaningful production without producing more iron ore and more steel. So it's, you're not, and it's really the same situation in China, where it's, almost exclusively comes as a byproduct of steel production. So these companies are not going to produce more steel just to get vanadium. That being said, the Chinese market is, all Chinese markets tend to be a bit more opaque. So it's hard to tell, at least for somebody like me who's not in China, doesn't really have any contacts there. It's hard for me to tell if there are sources of supply there that are being brought online, or if not. I tend to think that they're a little bit caught off guard too, because the rebar announcement only came back in January, which doesn't, if that was the first time that they heard about it, they have not had a lot of time to prepare for it. And, various estimates have the potential additional demand from rebar, from higher quality rebar over the next 3 years. The additional demand of vanadium could be anywhere from 5,000 to 25,000 tons per year. So the question is, if they obey, it seems like if they obey the law, there's going to continue to be serious upward demand for vanadium. It's really, and at this point now, it looks like it's a race with a few companies that are producing to grow their businesses, because they're companies like Largo and Bushveld, their cash flow right now is enormous. I mean, Largo's operating margins rate at the current price are like 80 or 90%. So, they're just raking in cash. So the question is, how much are these companies these primary mines, how much are they going to invest to expand production? So the way I see it is that the price is going to remain elevated for several more years. It probably, if I had to pick a price, I would say probably it averages 30 next year, 2019, before a slow decline, back to where I think it'll be probably. I'm expecting we're going to see a structurally higher price level, because the changes of where supply is coming from, and historically vanadium has averaged in the $6 to $8 per pound range. When I say vanadium, I mean vanadium oxide. So I wouldn't be surprised to see that 6 to 8 shift to an 8 to 10, or maybe even a little bit higher, but to be probably a bit more conservative, the $8 to $10 range. Really, $10 per pound is a good long-term price, because at $10 per pound, the vanadium redox flow batteries work. They're pretty economic at $10 a pound. At the current vanadium price, they're not economic. So, miners that are selling their projects because of the energy storage at the current price, it's not going to happen. So what the vanadium industry really needs is I would say what it really needs is a $10 long-term price, because that will incentivize. It's enough to incentivize the best mines to produce, and it's also a price that will make the energy storage economic. And also, vanadium is a very abundant metal. It's not like a cobalt where there's very few primary deposits and they're in bad jurisdictions. It's pretty abundant, so the supply can be there at the right price and at the right demand. So, it could really, ultimately, looking out 5 to 10 years, vanadium could really, become a new major metal market. I think there's potential for that.
I think there could also be a comparison to draw on the narrative side between uranium and vanadium. Most people are aware that the cost of the uranium fuel for a nuclear reactor is not very significant compared to the cost of installing that nuclear reactor. And not looking at the VRB market, so just looking at the steel rebar side of the market, which is 90% for vanadium, there's not a tremendous amount of vanadium that goes into the steel. So it doesn't significantly increase the cost or have any impact on the cost of the rebar. So that certainly can help in keeping us a niche market like this elevated.
Yeah, one thing I forgot to mention too about vanadium, another factor that also doesn't really get talked about is 10 years ago, China was producing at least twice as much iron ore as they are now, but now their production is below like 200 million tons per year. It's, they're importing about 75 to 80% of their iron ore, mostly from Australia and Brazil. So they're, just from that standpoint alone, their vanadium production, their byproduct vanadium production is down from where it was. When we had these past price cycles where vanadium shot up and then it quickly fell back down, well, things are differently now. So it's going to be interesting to see how it plays out.
Absolutely. Well, Josh, thank you very much for coming on the program today and spending some time with our audience. I once again want to let everybody know that they can find you on Seeking Alpha under Industrial Mine Finder. And Josh, we'll get back in touch with you in a few months' time here, catch up and see how the base metals are performing into 2019.
Yeah, that would be great. It's going to be interesting to see. I think we're at an important crossroads right now. It's going to be interesting to see how this plays out in 2019.
Think you understand the junior mining sector, and you think that the participants in the mining sector, junior mining sector, are good people and kind people, hit the bid.
How violent that term could be, it actually could be quite violent. It could be a rip-your-face-off uranium rally.
And the world is always going to need raw materials. It's going to need copper and gold and nickel and so forth.
Totally destabilized. Hey, Troll, did you hear what's going on in Yemen?